let's see. Let me make sure we good. We Gucci. I have a curved monitor, so it's hard to. It's tricky. It's tricky to get the entire screen on it, especially the corners. The corners ain't never gonna be accurate, right? All right, that's as good as it's gonna get right there. All right. If you was joining me on the YouTube video, this is gonna be the live stream. The live stream, I can start off where I want to start. So basically, on my trading view chart, which is my interactive charting platform. Oh, you got a notification. Maybe it's something I should look at. Maybe it's something. All right, what happened is markets moved 10 pips below the 8 a.m. candle open price. You guys are in. Let's see, look at the profits that you guys in. A little bit of profits, $1 now, right? And it touched the first red line below the black line and below the pink line. This red line indicates 10 pips below the 8 a.m. candle open price. We got in at 5 to 6 pips below, and we moved about 5 to 4 more pips lower, right? And then it sent an indication to my phone that we reached the first primary level, which is bearish, level 1. Bearish means down or below. And then this is the first level, which is 10 pips below. And if markets continue to move lower to bearish level 2, which is going to be 20 pips below, since they're all spaced 10 pips apart from each other, all the red lines and all the green lines, that for me, I have to close my open sell position, my pending sell limit, right? I have to close it because that is the idea for the day. That means that at 8 a.m. prices are going to move 20 pips in any given direction. If I didn't get into the trade before price moved 20 pips, I don't believe it's going to, on a probabilistic basis over a series of trades over time, I don't believe that it's going to move any more. Sometimes it goes backwards. So all the profit is gone, and the best trading entry, in my opinion, is out of there. So I close my trade. But for you guys, since you guys entered to a sell position, that just means that you guys have officially completed the first range, which is 20 pips from the 8 a.m. candle open price. You can close your trade for profit. You could hold on longer for potentially more profit. You can take your stop loss and then trail it to break even, or you could trail it to be right behind price action. You could do it right at the level, and if markets decide to move back, you instantly get out, or you can move it below the previous level and then allow markets some time to fluctuate. Markets usually fluctuate within a 10 pip range, so it'll go back 10 pips or a little bit, 10, 12 pips, and then continue lower, or it might go back more and fluctuate by the entry. It could fluctuate back up to the first bullish level. Since we're in a sell position, where the first bullish level is going to be where our stop loss is. As you can see, the dotted line here. If it does that, then it will probably hit your stop loss or come close to your stop loss and then move lower, or it might change direction and end up being a bullish outcome, and then you're out of the trade, right? So there's different outcomes. Since the way that you trade is instantly at the 5 pips below the 8 a.m. candle open, you have a pretty decent range for markets to fluctuate. And the deeper markets go into profit, the deeper your margin of error will be, and then your profit and loss, right? So I do have a plan. If you in the Magnum Open Trading Solutions strategy, or Magnum Open Trading, whatever I call it, right? In that plan, it's going to give you guys the options, but it's going to give you guys like the beginner options, which is go ahead and show your stop loss behind price and lock in profits, because it's going to make you feel better inside when you close the trade for a profit. And then if markets is moving very fast, then you can then it won't hit your stop loss. But for the most part, the probability of hitting your stop loss is higher. But at the end of the day, you're closing profits. So that's all that really matters. And then when trades don't give you no profits at all, you can go ahead and close it, right? So we have that part of it. What's next? And for me, I'm still waiting for price to go back and enter me at this blue line right here and then move lower. All right, so that is that. What I do want is, let's go into analysis, right? Now, it's going to get a little technical for some of you guys, especially, well, for any beginners or for anybody. It's going to get technical for everybody. because I don't think anybody knows how I trade. But it's based off of mathematics and based off of logic and price and time. So it all makes verifiable sense, right? First, I'll just give you a quick rundown of what you're looking at. What you're looking at right here is the Magnum Opus Trading Grid, or for analysis, or the Magnum Opus Analysis Grid for short. MOTS, MOTAS. I'm gonna get these names down pat in the future, guys. So just bear with me, right? But what you're looking at is a template. This is a template that organizes price and time. It organizes price action into proportionate data sets that are organized in hours, days, and the overall week, right? And then it actually has more information where we divide price into levels. So instead of willy-nilly looking at price action, this confusing zigzags, right? You can apply a filter or a template or the grid and put price action in reference to time, duration, which is an hour, a day, a week, and then distance, which is 10 pip levels. What happens is people get confused because they don't know what time they're looking at. Willy-nilly, some people don't even use the bottom of the charts. They don't know what time they're looking at, or it's hard to identify what time you're looking at without hovering your cursor over it. And you don't know how price action is moving in reference to time. And then, since price can move 110, 3, 5, 7, 35, 22, 11 pips up and down, or movements up and down, it gets confusing. But if you put it in reference to in levels, when price moves a certain distance, that is called a move. If price doesn't move that minimum distance, don't even worry about it. But what's going to happen is, even if price doesn't move that certain distance, it has to move across time. So if price, let's say for this example that we're looking at, I only identify price moves, which you see by these little dots over here. When price moves 10 pips, I identify that a valid move up, or I identify it as a valid move down. If price doesn't move a distance of 10 pips, I do not identify that as a valid move. But if 1 hour passes and price doesn't move 10 pips up or down, I identify that as an hour without a valid distance, or an idle hour, right? So even though I'm not measuring a certain distance, or I didn't have a valid move, a valid time has passed. This is very important to understand. This is very important to when you start understanding how price action works, right? Because we all have the same data. Anybody can log into TradingView and get this information. Because we all using the same data, and unless you apply a filter, or unless you understand how price action is moving, or have a reason or a methodology or a way of analyzing price action in a way that can generate trading opportunities that can potentially generate profits, you are going to be confused by this data. It's going to be very confusing. And by using a framework built off of the only data that is available at the time, not including volume, I want to put actually there, price and time, then you could analyze that zigzag in reference to something that is quantifiable, something that is static, something that is real. You get what I'm saying? Like an hour, like a certain distance and stuff like that. And when you do that, you will be able to define and understand how price action is moving in terms of whatever framework that you're using. For me, it's a mathematical framework. So the key to this entire thing is based off of logic, right? So let's speak about that a little bit. I didn't just come up with this right here. It starts making a lot of sense, but I didn't just come up with this. This is already in the charts. All of this information is, I'm highlighting what is already there. Let's look at the big rectangle here. The big outline rectangle is 1 week of Forex market. It's one Forex market week, right? It's a week of price action, all the price action within 1 week of Forex markets. When I realized that Forex operated on a schedule, That's when my journey actually began of how I created this, or how I discovered. I don't like using the word created. It's more of a discovery than it is a creation. How I discovered this grid, or how I discovered this framework and this whole methodology of looking at price action and reading price action and trading price action. So what happens is, Forex market operates on a schedule, and it has to respect this schedule, unless you have little caveats like holidays, like Christmas is coming up and stuff like that, where markets are closed. But in general sense, markets operate on schedule. Forex markets are open to trade at Sunday 5 p.m. You see that left hand side of the rectangle? That is the start time. That is Sunday at 5 p.m. and price or markets are open continuously 24/7. 24 hours around the clock, all the way to Friday at 5 p.m. This is the right hand side. This is the beginning, start time. That is the stop time. That is a fact. That is an indisputable, unchangeable fact of how Forex price data is expressed over time. It has a start time. It has a stop time. We can agree on that. Now, from Sunday 5 p.m. to Friday 5 p.m. is a continuous duration of 120 hours. From Sunday 5 p.m. to Friday 5 p.m. is 120 hours from the beginning to the end. Then that's 120 hours, right? Then I was like, you know what? If Forex is not, it doesn't work. If Forex is not open 24/7, it's not a what? I think 7 times 24 was like 120, 148, right? It doesn't go. It doesn't run 148 hours straight across, but it only runs 120 hours. 148. Am I tripping? Sorry. I'm not the best with math. It might seem like it, but don't get confused. Don't get it fucked up. My bad. Times. You see, I'm telling you, I ain't going math. 168 hours, right? There's 168 hours in our human time, reality, whatever, clock time, right? Week in a real week. Real week is Sunday. Sunday 12 a.m. back to Sunday 12 a.m. Whatever you want to call it, wherever your week started at. Well, basically, it's 168 hours in a week. But Forex only operates on 120 of those hours, starting at Sunday 5 p.m. and ending at Friday 5 p.m. And that's a duration of 120 hours. Now, in your real day, there's 24 hours in a day, right? I was like, if Forex operates on 120 hours in the day from Sunday 5 p.m. to Friday 5 p.m., what happens if I divide all of those hours into days? Which is, if it's 24 hours in a day, I was like, if it's 24 hours in a day, what happens if I divide 120 by 24? It gave me 5. Even. That was the most important thing. It gave me an even number. It could have gave me a weird number or whatever like that, and then I probably would have went on another thought process, another path. But what happened is it gave me an even number, and I'm like, what the hell? Then I did it. I put the chart on TradingView on the hour time frame, and I figured out where Sunday 5 p.m. was, and I figured out where Friday 5 p.m. was, and then I created a box, this rectangle, and I made it 24 hours long, and I stacked them side by side, and they fit evenly like a puzzle. Then I was like, what the fuck? Excuse my language. I don't know if some people curse, some people don't curse. And I'm like, what the hell? It fits perfectly. Okay. So instead of having 7 days in a week, Forex has 5 days in a week, right? That's interesting. Then I'm like, all right, cool. Then I was like, okay, I got the week. Then I divided into the 5 days, and then I took the top of the box and then the bottom of the box, and I started putting at the top of price action and the bottom of price action. So I'm not gonna do it manually. It takes time. It takes a while. So I was like, all right, this is the high of the week. This is the low of the week. This is the high of day 1. This is the low of day 1. This is the high of day 2. This is the low of day 2. This is the high of day, so on and so forth. Then I was like, oh, okay. Then I did it for No. Then I was like, okay, cool. Then I did it for every week that I could get on TradingView. And it just, all I had to do was I copied this and I pasted backwards. I copied the days and I pasted them backwards. And then I was like, what? Ain't no way that all of these things are all confused by all of this. But when I put it in these boxes, they fit. I'm like, ain't no way. And I did it as far as time could reach. You can do it, and it will evenly, and maybe not on Christmas where it shuts down, but for the most part, it will evenly do these weeks. Every week, 5 consecutive days, boom, bam. We reset the chart. Then I'm like, okay. Now you fall down the rabbit hole of how price action has to respect time. It can go up and down all it wants to, but it has to respect time. It has to express it in this framework of time, because it's gonna start at a time and it's gonna stop at a time. Then I'm like, all right, cool. Now that I got him in boxes, right? Let's just call them boxes for some. Now that I got him in boxes, what if I measure the boxes, right? Now I got them about, what happens when I measure? So I started measuring all the boxes. I get my little measuring tool. This is 42 pips. This is 59 pips. This is 35 pips. This was 77 pips. And then I measure the week. The week was 115 pips. That's, you can see on the top of the boxes, right? These are all of the ranges. I'm like, okay. And I did it for all of the boxes, right? All of them, and I got plenty of information, but these are the cleanest ones, right? I did it from all of them. So each week had a range. Each day has a range. But more importantly, this is when I was like, wait a second. When I was just willy-nilly trading and I was trying to, rape the markets or whatever these dudes I was seeing on Instagram and on YouTube and on all over was trying to do, they catching 100,000 pips, they catching these big trades and all this other, markets is going from pointing, the market is going like, they showing you trades like this big and all this stuff, right? I was like, yo, wait a second. All right, markets went back to the entry. I was like, wait a second. Markets on day 1 move 42 pips. Markets on day 2 move 59 pips. Markets on day 3 move 35 pips. Markets on day 4 move 77 pips. Markets on day 5 move 40. Where are these 100 pip trades? Where are these big, massive trades? And then I'm going day by day. I have all the days. I measured all the days. Where are these humongous trades these guys are talking about that they're catching every day? You get what I'm saying? I'm like, where are these trades? Then I was like, all right. Then I started to notice, where is it moving? All right, so if markets continue moving higher and get to this blue line, I'll get in. But you guys are not in drawdown, a little bit drawdown. We had negative 44 cents. But that's just market breathing. Don't worry about it at all. Number one thing you definitely be is calm. Ain't nothing that you can do, nothing that you can think that's going to affect the market and where it's gonna go. You already have your trading plan. It's either gonna work or it ain't, right? So I'm like, then I started seeing like, you know what? The big days don't happen that often. You get what I'm saying? Yeah, I seen days with 100 pips, 200 pips, or whatever crazy moves, right? But on average, market actually doesn't move like that. On a daily average, markets only move like thank you for the like. I was like, markets only move like a certain amount of pips. Then I figured out. Then I looked at all the days, and I was like, what's the smallest range that can fit in every day? Like every day will move at least this amount, right? Then I came up with the number 20 for Euro USD specifically, right? This is the framework. You gotta just keep in mind what I'm saying, right? Keep in the process, right? And I'm like, all right. The most on average, if I want to trade every day, the bare minimum I can expect markets to move without knowing the range that it's going to move beforehand, right? So I'm never going to know because it's a random distribution, technically random, right? Of range that markets are going to move every day. But if I want to trade every day, I have to be realistic. I have to use logic. Like, what is the minimum range that I'll catch every day. Then I seen if I trade within that framework of 20 pips, I can expect on average minimum, whatever I say, average minimum of 20 pips within that day. Anything past that is based on probability. I can't expect that it's gonna happen or it ain't gonna happen, right? And then I'm like, all right, boom. Then I was like, all right, boom. I started working with that. I started doing a whole bunch of try to trade without finishing on all the information or whatever like that. Boom. And I'm like, all right, cool. Next, let me go back. Next, where I might be skipping steps. I'm trying to relive the story or relive the I think that process probably took me like 5 to 4 years, right? Of just trial and error. So next I was like, theoretically, right? What's the range? All right. Next I was like, all right, boom. Now I got to figure out, okay, a range is a range. That's what happened the entire day. That's what happened the entire week. Now I got, for me to trade, because I'm trying to trade, I'm trying to figure out where do I cash this 20 pips every day? I'm like, damn, I can't find this 20 pips. Like, it's across. Like, I put my trade, I hit stop loss, it'll move to 20 pips. Or I put my trade, it doesn't get 20 pips at all. Or I put my trade, and it does move 20 pips. I'm like, dang, I gotta figure out where to place my trade. Then I was noticing, what I was noticing is that some hours move more than others consistently. I'm like, all right, this hour, usually maybe 5 p.m., 6 p.m., 7 p.m., 8 p.m. in a day, I'm trying to place a trade. Markets ain't moving for a goddamn. But when I'm trading at 8 a.m., 9 a.m., 10 a.m., markets is moving. And then when I was looking at the highest point and the lowest points of the day and stuff like that, and I'll hover over it, and I'm looking at all the days across, consistently I was thinking okay, around this time, that's where the entire move at. Around this time, that's where the entire move at. Then I'm like, all right, cool. What if, okay, I have the range, I have the time range, I have the time frame of the day, I have the range of the day. I have the time frame of the week, I have the range of the week, I have the time frame of the day, I have the range of the day. Why not find the time? Why not find the time frame of the hour in the range of an hour? But I was like, damn. For a while, I was like, damn, it's 120 hours a week, nigga. You got me messed up if you think I'm gonna go ahead and look at every hour. Then basically I had to, right? So so basically I was like, okay, cool. Then I measured the range of every hour, right? Boom, boom. I'm like, all right, this hour, this range, this hour, this range. I do it 120, do it 120 times. Believe me when I say 10,000 hours of mastery. You do anything for 10,000 hours, you become a master. That's true. Then I was like, boom, boom. All right, the ranges of the hours were showing me patterns. Then I started. I don't want to get into patterns yet. Then I was like, okay, boom. I was like, this is the time. This is moving. This hour is bigger than this hour consistently. This hour is bigger than that hour consistently. Bam. And then I was like, all right, cool. First, I ain't gonna lie to you, I was trading at 5 a.m. because I was like, you know what? I don't want to get into that big move too early because based off the way that I was trading, I was hedging. It's a bunch of stuff, right? I didn't want to get into the trade too early. I wanted to get in before the trade happened, have my trade set up waiting for price action to move, and then when price action moved, I was in before it happened. When I was trading, I was noticing that I was trying to get in once it happened, and sometimes price will move too fast for me, and then I wouldn't be able to get in, and then it just was downhill from there, right? But when I started, I tried to trade at 5 a.m. I was letting markets blah 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 blah, right? The point I'm trying to get is that there are certain hours which have the biggest ranges, which is going to give you not a better winning probability, but a better risk reward or more the potential of getting more profits when you are right. You get what I'm saying? And if you use a stop loss, you can consistently lose the same amount, but the top side or the upside of the trade is a lot bigger. Then I figured out about there's certain sessions, right? What happens is you're not the person. When I came to another realization, that I'm not moving the market because I put my little 10-cent trade and my little dollar trade or my $10 trade or my $1,000 trade, whatever it is. just because I put my trade in markets, my trade don't even actually go to the markets. I'm trading what do you call CDFs or something like that, derivatives and stuff like that. If you really understand like markets, I'm trading a simulation. My brokers is simulating what's actually happening. My money is not even going to the market. My money stays in my broker's hands, and he just pays me the offset or whatever. My markets ain't move. My trades ain't moving the markets because I want markets to go up. Ain't gonna go up. No matter how much, which God I pray to, how much time I look at the charts, I blow on the screen, pause, I do everything. It ain't gonna move. So I was like, all right, dang, I gotta move with them. I gotta go with the movers that move the markets. I gotta figure that out. So I was like, okay. Then I figured out about sessions. So there's times like the reason why markets was moving at 8 a.m. and onward, or it was moving at 1 a.m. and onward, it is because at 1 a.m. around that time is the London session. The people over there in the UK and their stock exchange and their people are waking up, going to work, and institutions, hedge funds, and banks are placing their trades. They're at work and doing all that stuff. They're moving that market at that time because they're up and they're trading. Then at 8 a.m., around 8 a.m., 9:30, whatever time you want to call it, that is the New York session. That's where the Wall Street is up. They're at their desk. They're moving the markets. It's really algorithms, but that's another computer algorithm that we run 24/7. But that's another conversation for another day. But they're moving the markets at that time, so I have to align my trade with how they're moving the markets. Okay. And then I started getting trading success, right? That's when I started like, all right, not only do I have a framework where I can expect, all right, I'm going to trade within this range. I know when I'm going to trade. I know that I can expect that range daily. I know how to get into the trade, and I know how to calculate the trade, and blah, blah, blah. Cool. So I'm in winning trades. Let's call it that. Don't mean that I was making money, whatever like that, but I'm in winning trades. And then the analysis is making sense to me. So boom, that wasn't enough. I'm not making money though. Cool. All right. I got the Forex market week. I got the Forex market day, and I'm analyzing the hours. I know which hours move more than other hours. What else? Then I figured out, right, the ranges, whereas like, okay, the ranges was telling me, let's say 59 pips. The range was telling me on day 2, markets moved 59 pips. But I can go to another day. I can go to this one, which is closer to 59 pips. Day 5 of last week, markets moved 62 pips. It's about the same thing, right? 3 pip difference, right? Even though I was trading at the same time, the same way, every day, blah, 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 this 59 pip move and this 62 pip move is close to 59 pip move. It didn't happen. It doesn't happen the same way. I'm like, damn. I know the range, which is I can catch 20 pips every day on an average minimum. But this 20 pips is coming this way, that way, that way. Every time it does move 20 pips, but it's just doing it too many different ways. I don't get it. So I was like, damn. All right, cool. I got it. I'm getting into winning trades. I know the money's there. I'm just missing out on the money. So I'm like, all right, cool. I gotta figure out how markets is moving within. I need more information. I gotta figure out how markets is moving within, not only within the week, not only within the day, but within that trading session. I gotta focus on how markets move within that trading session, not the overall range. The overall range, it just gives me from point A to point B, but it takes 24 hours to create that point A to point B. It could move the biggest range, the high. It could move from the high. So what the range is the measure from the high to the low, right? That's your range. That's how you figure out the range. From the highest point to the lowest point, the high minus the low equals the range. And whatever happens in that is price activity. So I was like, all right, cool. What I was going with that? I got the range of that thing. Now I need to figure out the range of the session that I'm trading in. So now I have to define my trading session. So I was like, all right, I'm gonna trade at this point in time, and I'm gonna stop trading at this point in time. And the range that happens in this point in time is what I'm gonna trade. And I have to study that, the activity that happens within the high to the low, because it could make the high to the low here, it can make the high to the low here, it can make the high to the low here. It could start at the beginning of the day, it could actually happen in New York session, it could happen in London session, or it could happen all the way. It could happen like, it could actually be the last hour of the day, it goes up and it goes all the way down. Like, damn, all right, cool. All right, I gotta figure out the range, and I gotta figure out the price activity that happens when I am trading within the range that I'm trading and within the time duration or the time frame that I'm trading. So I define my time frame. It's all different time. It was from 5 a.m. to 5 p.m. I started that because from 5 a.m. to 5 p.m. proportionally it made sense to me. If I divided each day by 12 hours, then I will have a 12-hour window to trade, which is also a 20%. Is it 20% or a 10%? 5 divided by, that's gonna be, I think it's 10%. It was an equal fraction of the entire week, a 50% fraction of each individual day, and I believe that would put the probabilities of me catching the trade over a series of trades, or me catching the right session over a series of sessions, that if I'm trading 10% of each day, the same 10%, sooner or later that trade is gonna happen within my session, right? Then it got shorter and shorter and shorter, and then now it's a 4-hour range that could be extended to 9 hours, so on and etc. We're not gonna talk about that, but what we're talking about is analyzing price activity, where the zigzags that's happening within my time frame that I was trading. So what I was doing beforehand, I was trading off of the hourly candles. Now, because I had to go ahead and trade within my session, I had to drop down to a lower time frame to analyze the zigzags, the up and down movements that was happening within my trading session. So that's where it got to the horizontal lines that I got. It took me a while. Now we're getting to like new developments that are less than a year old. Now it got me into that, where I was like, all right, I got my hourly range. I got my 4 hours, or where I was trading like 12 hours, then it dropped down to like 9 hours, then it dropped down. Now I'm at 4 hours, right? I got my time frame range, right? I'm looking at the price activity, the zigzag that's happening between my range. What happens is these goddamn zigzags were moving at random. Some would be 20 pips, some would be 50 pips, some would be 100 pips. It'd be all types of zigzags, and it was just confusing me, right? Because my trade size, let's say my size, the distance between my entry and my stop loss is gonna be your trade size, right? Or your margin of error. So if you get into a trade, I give markets this amount of wiggle room to let me know if it's gonna move in that direction, or it's gonna take me out at a loss. So let's say this is my margin of error right here. If I want markets to go up, right? And this is my margin of error, and price action goes down, and here's this level, which is this red dot right here. That means I was wrong, and I lost the money, and I'm out the markets, because markets might continue lower. So I was like, all right, this is my little margin of error and stuff like that. Where was I going with that? My trade. What happened was, what I was doing, and what I see a lot of people doing, is that they'll measure, they'll trade supporting resistance, and they'll be like, all right, put my stop loss below this low. I'm going to put it right below. And now my stop loss is like 11 pips. And then my TP is going to be at this high. Boom, bam. And I have my TP is going to be like 75 pips or something like that. Some arbitrary number, right? And it was dependent on price action that was happening at that moment. High, lows, or whatever you use, right? You don't know what size your stop loss is until you build the trade, right? And I'm like, dang, bro, these zigzags is coming in different ranges. My margin of error is all these different ranges. My risk reward is not even. And it just wasn't clicking. So I was like, you know what? This price action is moving too random. I gotta figure out how to read price action and trade price action evenly. I'm like, evenly? How the hell can I do it evenly? So when I was trading originally. After a while, I started trading with a 10 pip stop loss. I basically tried every stop loss in the book. And then I figured out, you know what, that little 10 pip stop loss was giving me the right trades. Even though I didn't know how to exit out, I didn't know risk reward, I didn't know risk management, all that stuff. But whenever I had a 10 pip stop loss, it would give markets enough wiggle room to either it'll go shoot straight up into profit, or wiggle enough, but it won't hit my stop loss to take me out the trade for a loss, and it'll continue going forward. So I was like, you know what, this little 10 pip thing working. So I was like, this is a I'm adding a little bit of bullshit. This is a little bit of bullshit, but it's just gonna make the story make sense for you, because I'm trying to summarize years of trial and error. This little 10 pip move making sense, especially on Euro USD. That shit is making sense. Now, what if I measure all of price action in ranges of 10 pips, right? Then I was like, all right, I had the range. I had the range of time, whereas like the range of a week was 120 hours. The range of the day was 24 hours. The range of the hour was 60 minutes. Now let me divide price action evenly. The time is all perfectly even and beautiful. But what if I measure price action evenly? So what happens when I started measuring? I like boom, 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 levels. I had these levels. It wasn't beautiful like this. It was, you'll see my other videos and stuff like that. It wasn't like that at all. But what I noticed is that 10 pip thing was containing price within a margin of error that made sense. And then I was like, all right. What happened is I was looking at days. Market price will go from, let's look at, for example, right? Price will go here, then here, or price will go here. Well, let's look at a big move. Price will go here, then all the way up here. I'm like, man, all these moves. This is a up move. This is a bullish move. That's a bullish move. That's a bullish move. That's a bullish move. But they all come in different sizes. I gotta define what a move is. If markets move this distance, that's what I consider a move. Because if market's not going to tell me, if I can't go on research and nobody's telling me what a move is bullish, what a move is bearish, what size is a retracement, what size is a reversal, what size is a double top, what's the exact mathematical definition of a bullish engulfing, bearish engulfing, nobody can tell me. All of these are subjective. I think it's a move. You think it's a retracement. I think it's a double top. You say it's not completed. I think it's a trend line. You draw your trend line differently. I'm like, damn, unless I use math, we can't all come to the same decision on what we're looking at. So I'm like, okay, if 10 pips is a good range for my trade to give markets enough wiggle room to decide what direction it's going to go, what if I divide all of price within the time frame range by 10 pips? Then I was like, holy cow. Man, holy shit. I'm a grown-ass man. If you're trading, you over 18. Holy shit. It was like, okay, it wasn't making too much sense, but it was looking more organized. So I was like, okay, let's go with this. If markets move up 10 pips, I'm going to call that, I don't care what nobody else says, whatever, I'm going to call that a bullish move. I'm going to call that a move up. If markets move down 10 pips, I'm going to call that a bearish move. I'm going to define that as a move down. Then I started doing that. I put the price action in the grid, right? Then I started, every time market moved 10 pips from point A to point B, I would put a dot there, a dot there, a dot there. Now I'm like, oh, then it started making sense. I'm like, oh crap, it's making more sense. They'll move up, it'll move down, it'll move up and down, all this stuff. Then, since it's in a range of an hour, some hours had multiple strikes, some hours had no strikes, some hours had one strike. And then I'm like, oh, okay, I'm on to something now, right? I'm on to something. Then I had to figure out that, you see, this blue dot here and then these white dots. These are these variations. Every time you put markers in a framework, it will do a variation that will just blow your mind, right? Pause. So I was like, okay, I got a bullish move, I got a bearish move. Sometimes market will go straight up, not have a bullish trend, then not have a bearish trend, quote unquote. These are all concepts. I don't like trends. I don't like those words. But I have multiple green dots going up. I have multiple red dots going down, and it was a lot more noise. So I was like, now if markets went up, if let's look at an example. Shoot, let me find an example for you guys. All right, let's start at the beginning of the week. That's probably gonna be the best example for you guys. All right, let's go to the beginning of the week. All right, if the week starts right here, this is the beginning of the map, right? How we're gonna track price. I was like, all right, if markets move down 10 pips, that's the first move down. Then if markets move back up, is that a bullish move? I was like, then it will move up again, and it was doing all these zigzags where I had red, green, red, green, red, green, red, green, and I was like, you know what? If markets move down first and then it goes back up, we're back at where we started. I can't necessarily say that's a bearish move because we're back at zero. So I created this, it's called a reset strike, where it's like if we originally moved down, then we move back up and we're back at where we started. This is a reset. It's not bullish or bearish anymore. It's neutral. But if we move another 10 pips bullish, now we're going up. Now then it started filtering where it gave me more definition. This was the key to creating what you will see here as a pivot. So if we were moving up, we went back down. Sometimes market will go back up, it was still bullish, but sometimes market will go back down. And if you look at that V shape, a reversal, a change of direction, and then a confirmation that it reversed, I created that pivot. Now I knew I had the mathematical in my framework definition of a retracement and a reversal. I'm like, what the hell? I'm going in the right direction. Whenever you start seeing things like this, in my head, it was like, whenever I start seeing things that made sense logically, but it had a mathematical explanation to it, I'm going in the right direction. Cool. So I'm like, boom. Bam, that happened. Now I got it evenly. But what was happening was, even though I was measuring the range of hours, some hours didn't move a distance of 10 pips. What was messing me up was some hours would be 10 pips, but from point A to point B wasn't 10 pips. It'll move 5 pips up, then 5 pips down. The range was 10 pips. It'll be 10 pips within the range, but the distance from the start to the furthest point wasn't 10 pips. So I'm like, dang, this is confusing. Some hours ain't making no damn sense. So I'm like, you know what? If I'm thinking about markets are not exact. Markets, you don't want to look at an exact pip because it's going to mess you up in trading. Because when you're trading, especially on MT5 and TradingView, what happens is majority of traders are trading on TradingView. Majority of traders are analyzing on TradingView and then trading on MT5. They have two different price data. I don't care if you're on the same broker. For the most part, it's off by a micro pip or two. When you're trading, sometimes your analysis on TradingView doesn't hit stop loss, but your analysis on MT5 hits stop loss. I'm like, dang. So if I can't look at markets as a exact point to point type of thing, I have to look at it as a range of things, right? And I'm already having within this little margin of error or this range. So I'm like, all right. And then I had a range of, or a mathematical definition of what a valid move is, which is 10 pips. So I was like, all right, sometimes in this hour it's not moving 10 pips. So if markets doesn't move from point A to point B 10 pips from point A, because markets is duality in nature, it can move up and down. I don't want to get too deep into that, but it just didn't move a range where I could, from the start point, the open of the candle, or the open of the level, or the open of the session, 10 pips, but it moves an hour. So basically, shorten it. I was like, all right, now if markets don't move a distance of 10 pips within an hour, I'm going to put this white strike here. Hopefully you'll be able to see the white. I'll put a white strike and say markets fluctuated. Markets was idle. Markets didn't move markets did not create a valid move within the hour. That's a mathematical framework where it's like, if it does this at this time, or if it does this within this range, this is what it is, right? Or this is what it ain't. That's what I wasn't getting. I was defining what what things were, but you also have to find what things are not. So if markets do not move a distance of 10 pips within an hour, it's not bullish or bearish, it's neutral. I'll put the white dot at the end of that hour, right? Now all the hours made sense. Some hours were idle, some hours had a move, some hours had a move back, which is a neutral move where it did travel a distance, but it returned back to where it was originally the last hour, or it doesn't move a distance of 10 pips over a range of hours. Now more patterns were happening. Now I know, like for example, right? From 5 p.m. at the start of the new day, from 5 p.m., you usually won't have a distance from the open of the day for 8 hours. Markets would not, not for some reason, because I know the reason, right? But I was noticing that at the beginning of the day, it wasn't making a strike. It wasn't moving. So I'm like, okay, that pattern. So if market's not really moving around this range of time, I'm not gonna trade it. I already wasn't doing it, but now I had the mathematical reason why I wasn't doing it. And then the logical reason was this is like Asian session, or this is like the downtime of the markets where it doesn't really move that much because there's no trading activity. There's no big players in the markets to move it. But now I have the mathematical definition. Markets isn't moving 10 pips at this range. So logically, I'm not going to get into trades at this time because 1, it ain't moving. 2, I'm asleep or I'm out and about. So don't trade it, right? So boom, now we're cooking with grease. You're gonna hear me say that a lot of times. Now the ball's rolling, we cooking with grease. We have the dirt, we have the range. I have the schedule of the week, right? 120 hours. I divide that 120 hours by the 24 hours in a day. Now I have the days that happen within the week, what happened in the week per day. Then I measured the ranges of each day, each week, and each hour. Then I define what is the valid move, so I know what hours moved, what hours didn't move, how much the hour moved evenly, not on arbitrary numbers like a 37 or 10 or whatever. No, it moved 10, 20, 30, 40. I have the ranges. I have the direction or the context of how it moved. So I know it moved bullish, then back bearish. It moved bullish, bearish. It reset. It didn't move at all. I have the mathematical implications of the move. This is 10 pips. That's 20 pips. That's 40 pips. That's 50 pips. That's 0 pips. Or that's negative. Now I had the values where if I move up, it's plus. If it moved down, it's the negative. And that's flipped, that's inverted when you're trading. Depends on the direction that you get into a trade. Then I created the context, right? So that's where we are here with the grid. You have the range, you have the time ranges, a week, days, hours. Hours have moves, bullish, bearish, so on, etc. You have your sessions. Some time frames or sometimes in the day move more than others. Then you have your scale. If I'm trading 10 pip stop losses, or I'm looking at markets in the ranges of 10 pips, I know where to put my stop loss. I know where to put my entry. I know where to put my TP. If I move it on different levels, my risk reward changes. I can win 30 pips while risking 10 pips. I could risk 20 pips if I want to make 40 pips. Then I have the context where it's like, all right, I understand that, okay, if we have 2 green dots, that means that it's the beginning of a trend. If we have a green dot, then a blue dot, that means that we have pause or may reverse. If we have a green dot, a blue dot, then a red dot, that means that we reverse. It's a 10, it's plus 10, minus 10, minus 10. Now we're moving in a negative direction. If I was in a trade, I went up 10 pips and I lost 20 pips, and I probably lost the trade. Things were starting to make sense. Boom, boom, bam, bam, bam. Remember, I'm ad-libbing a lot just to make the grid make sense to you. Hopefully that you can understand a glimpse into the framework of this. And then I was like, all right, boom, I got the context, I got the ranges, I got all this stuff. But when I put the markets in this grid or whatever like this, and I had the ranges, I noticed that I had risk reward embedded into the range. So if you know anything about trading, you're trading risk reward. If I put up $1 on this trade, and that $1 is expressed as 10 pips from entry to stop loss, I'm risking $10, right? Let's say $10 on the trade, right? That means every pip is worth $1 in a 10 pip range. 1 times 10 is 10. And then my take profit is 30 pips, which is $30. That gives me a 3-to-1 risk reward ratio, because 30 divided by 10 is 3. I'm risking 1 unit of 10 pips for 3 unit of 30 pips of reward. Hopefully I didn't lose you, but putting it in this framework let me know all the units, all the risk rewards as well, potential risk rewards. You could edit it the way that you want, or you can manipulate it the way that you want based on where you potentially put your trade. Then you have the strikes. These are going to be decision points as well. And then I'm getting too deep into trading theory and stuff like that, but hopefully just understand what the most important thing is. The grid that you're looking at here is based off of price and time only. You have the week, you have the day, you have the hours, and then you have the moves that happen within the day, the week, the hours. They're all interconnected. This all the way to that can be played in reverse, and they have a mathematical value that sum up the range, that sum up how it moved from an open to close, and multiple other things as well. But remember, it's all based off of math. Number one thing that that magnum opus trading solutions and the theory that I was doing, I'm talking about when I got to the understanding of that week and I got to the days, is that I told myself I didn't know none of this, right? I still didn't even understand how to read charts, but I promised myself, or I put it in the back of my head, that I'm not gonna learn how to trade. I'm not gonna learn how to analyze. I'm not gonna learn how to trade unless it makes logical sense and it made mathematical sense. If what I was doing could not be expressed logically and that could be repeated and verified mathematically, it doesn't matter if it made money. I was gonna ignore it. And then also I divorced the idea of making money. For a long time, you can ask my brother, who's my best friend, not my blood brother. Because he's such a close friend, he's like a blood brother to me. I sacrificed a lot of time not trading for money to pursue information and data. All right, prices actually moved back down. I'm not in the trade yet, but if we move to the second level down, I'll be out. Markets is fluctuating and doing a lot of BS. So what I did was, I pursued the data, and I realized that while I was trying to trade and I was trying to analyze, my thought, my perception, my view of the information was being skewed by my need to make money. So I gave up the trading. I demo traded, but I wasn't trading live because I didn't want my thought process. When I was getting these downloads and God was giving me the information, or just experience was giving me the discoveries, however you want to accept what I'm explaining to you, right? When I just started looking just at the information, I could see clearer. But when I was trading, it was warped. So I'm like, you know what? Fuck the trading, right? Fuck making money for right now, or for as long as it takes, right? That's why it took me 10 years. For as long as it takes, I need the data. And I'm only going to research the data, and it has to make sense logically, it has to make sense mathematically, and then somebody else that's coming after me after I explain it to them can replicate with mathematical accuracy the same thing that I'm doing. I was tired of watching these traders do all this analysis, get into all these trades, but you can go to their best trader and they cannot reproduce the analysis. They cannot always consistently reproduce the trades, and they cannot explain it with mathematical accuracy. If you're not following the scientific method where it's repeatable and somebody else can prove it the same way that you did, it's arbitrary, it's subjective, and it's just a waste of time. I had more ideas behind that, but I followed that, I pursued that, and that's what got me to where we are here, where all of this is mathematically understandable, because one thing remains true. Multiple things remain true, and some are arbitrary, but men lie, women lie, numbers don't lie. the universal language. Doesn't matter if you are Maine to Spain, Alaska to Nebraska. You could speak any language you want. You could be on any continent you want. You could be off planet Earth if you want to. Math remains the same. 1 + 1 is 2. I don't know if you're in a different dimension or whatever like that, but math remains the same. They send what they do? They send capsules into space with, I think, pi or something like that. They use pi or golden ratio or something. They use some mathematical thing. They don't use words. They use math to try to speak to aliens and stuff like that. So it was like, all right, if we send this mathematical thing, this math-based thing to space, the aliens get it. They will know that there is intelligent life on Earth and maybe send us back something in math. Because we might not speak the same language, but the mathematical principles are what governs the universe. So I was like, if I can't explain it logically and mathematically, it don't really make sense. So that's the thought process that I pursued, and that's what got me to this point right here. Now, let me give you guys a I'm telling you, I could rhyme, but that's why I say, like, teaching and trading is a passion of mine. That's why I really want to pursue it. That's why I want to open up to you guys, because I actually enjoy doing this. You get what I'm saying? I fell in love with technical analysis. I fell in love with the pursuit of information in this field, and just trying to make this trading thing work, bro. So now I'm gonna show you I explained it, but now I'm gonna visually show you how this grid is. Once you get the grid down, once you get the main points and the main little drawing tools on there, copy and paste. You can copy and paste to build a framework for future price data. You can copy and paste to analyze and backtest past price data. That's another thing that I got into when I was analyzing. I was like, in my head, before I even knew it, I was like, bro, the way that I analyze and the way that price action is, I know it's a mathematical equation behind it, right? But aside from that, that's another rabbit hole. But I know that the way that I analyze, if I can analyze it forwards and if I can analyze it backwards, it'll be perfect. I reached that point of my analysis. I'm pretty sure I have some things that I haven't discovered yet, but this is, I was like, okay, now I could go ahead and project the week forward, and then just all I had to do is the time frame. All you do is copy and paste it forward, and all you have to do is fit it to price action that actually happened. You can copy and paste it backwards and fit it to price that is going to happen in the future and that has happened in the past. And all right, boom, this is a beautiful framework and it works. So I'm gonna show you guys now. So the first thing you probably want to do, the order really doesn't matter, because I'm gonna do it in different orders every single time, but it doesn't matter because it has to follow logic and the time schedule. Is I'm gonna copy on TradingView's clone and move and paste the week, and all I gotta do is connect the sides together. Boom. Just lay it on the same. Let me look at the screen. Lay it on the same line here. And sometimes it's difficult for me. All right, boom, connected it. Now let's see if I zoom out. Now this is last week's framework. It got the high of, it got the, wait. It has the high of last week and the low of last week. Then I'll explain higher highs and higher lows to you guys later in another video. But if you understand basics, you'll understand that, right? So all I do is copy and paste it over. I'm gonna copy and paste everything over. I'm gonna stop talking. Nah, I'm not gonna stop talking. I'm gonna copy the week over. Then I'm just gonna copy the label of the week over as well. Copy, clone. Now we're in week 47. I don't know the ratio, and I don't know the pip size. All that is going to be confirmed at the end of the week. All I gotta do is this right here. That's my label for today, for the week. That's week 47. That was week 46. Next, I can go ahead and take, this is going to be the weekly open price and level. This is just going to be L0, which is going to be the basis of the mathematical equation as well as analysis of the week, right? This straight line, it goes from the open to the close, and this is going to be the price that the week opened at, which is the very important price to analysis and trading and the mathematical framework of the week, as well as the mathematical equation that I'm working on discovering and defining for you guys of the week, right? So if I go on, I remember, like I said, TradingView is not mathematically accurate to the data that's get on MT5, but I trade on MT5, so I'm gonna base this grid not on TradingView's price action, but I'm gonna trade it based off of MT5 FT MOTS price action, because I trade, and it's only off by some micro pips or a pip at a time, or 2 pips depending on spreads and stuff like that. But yeah, but you get what I mean. So I gotta put this in the weekly chart, and I got my data window open, and I gotta hover it over the latest week. Look to my left. The week opened at 1.16135. Click that. Now I'm going to 1.6. I'm fucked. I forgot. Remember, my memory is not that best all the time. 1.16135, and my memory is good. I just double guessed myself way too much. 1.16135. 1.16135. Copy. All I gotta do is change number 1 in the coordinates and change bar and price number 2 in the coordinates, and then change the label to the new price. Paste, and boom. The week 47 at Sunday 5 p.m. open at 1.16135, and that is the per minute open of the entire week of data, right? And I labeled that as L0. This is our base point, right? Next, I'm going to, I need to see if I can find it. How do I, let's see. I'm going to copy over the range. You could copy over or you could build it yourself. For me, copying is either a 24-hour box, right? Line it up with the range with the Sunday 5 p.m. Okay, in Forex market week, since it start at 5 p.m., the day starts at 5 p.m. It's going to end at 5 p.m. That's 24 hours, right? Just like your regular day is at 12 a.m. and then the next day is going to be at 12 a.m. And these boxes are going to be on top of each other. So I got the week, the range. Now I'm going to measure from the high to the low. Now remember, we're still in day 1. So the high and the highest and lowest price of the range hasn't set in yet. So the top and the bottom of the box is dynamic as long as price is still printing within this range. So you can move it up and down, but the left and the right hand side, which is the timestamps, are going to be static. And since we're on a 5-minute chart, it's going to be at every 55th minute, right? So instead of the beginning of the week, it's going to be laying on the left hand side, or the vertical line is going to be laying on the 5 p.m. candle. It's actually going to be connected to the 4:55 candle, because when one candle closes, the next one opens. Yeah, that's something I'll explain. It's not going to be exactly at the 5 p.m. It's going to be at 55, and it's going to end at 4:55, which theoretically closes at 5 p.m. and then opens at 5 p.m. as well. Closes at... I'm confusing my own damn self. But when you're drawing it and you talk to me, I'll explain it in more detail, right? So just know that that's a 24-hour range in time, and then the high and the low is dynamic right now since we're not at the end of the day. Now, before I was trying to figure out where price opened out on a daily level at the exact price, but now I'm looking at the level instead of the exact price. I'm looking at the price level. So since day 1 is going to be the base of the entire week, because the first day is where the week opens at and where the day opens at, they're going to have the same line. But when we go to day 2 and the other subsequent days, I'll show you guys how we draw the open level and not the open price of the day. So The week 47 opened at 1.16 and 135, and then the day one level opens at 1.16 135 altogether. Now I got to get a separate individual label for day one, bring it over here, copy that there, and just change it over, right? This is day one, we know that. The risk reward, we don't know that yet, or the units. And in the pips, we don't know that, and we only know that until at 5 p.m. today. There we go. So we got that. Now we got the daily range. We got the information. Next thing we want to do. Let's zoom in a little bit. Next thing we want to do is we're going to figure out. We're going to identify the valid levels. I do that because it's easier to do it now than it is to do the hours first. So I'm just going to figure out, I'm just going to find one of these daily levels, and I'm going to do that, right? So I got a little daily level line. It's just a line that goes across 24 hours. Make sure it's lined up, leveled up properly. Yeah, it's pretty decent. So you could put it above, you could put it below, it doesn't matter, right? Because you're going to need both of them. The first above and below levels you want to draw. Since it's green, it doesn't matter where you put it. Just make sure it lines up, and then we'll line it up. Just make sure the left and the right hand side line up with the daily range. But where you place it on the chart right now doesn't matter, because we're going to do it right now. So we're going to open our little calculator. We're going to start with 1.16135, and we're going to measure levels in pips of 10. So since your USD is expressed to the 10th, 100,000, 10,000, 100,000 place, or whatever. Hopefully that's right? 10 pip move is going to be measuring the 10, 100,000s, right? So 1.16135. Above that, 10 pips above that is going to be 0.001. That's going to be 10 pips. So we added 10 pips to this level. That's going to give us 10 pips above. It's going to be 1.16235. You could do that in your head after a while. I don't suggest you do it or do the mathematical calculation in your head, because sooner or later you will be wrong. You always want to use a calculator, and for the most part with trading, you want to use the EA. Why did I do that? I'm tripping. All right, let's leave the line green. I'm going to edit it, right? So this, I'm going to figure out 10 pips above this level right here, the level of the open level, L0, is going to be L plus 1. This is going to be level 1, which is also going to be plus 1, which can be also expressed as plus 10 pips, plus 0.001, or 10 pips above the weekly open, daily open price, and which we already calculated, and we're going to paste that there, and that is our first bullish level expressed as L plus 1. And that is on the grid, proportionately 10 pips above the weekly open price and the daily open price, which is the same thing right now. Next, I'm going to clone it, make another one. I'm going to turn it red. And I'm going to name it L minus 0, which is going to express the opposite, which is 10 pips below the level. And you can either subtract 20 pips from the current level, or you could just subtract 10 pips from that the main level, right? So I'm doing the long way for you guys. 135 minus 0.001 equals 1.16035, right? Copy that. Paste as the coordinates on both. Paste there, and then leave that there. So we got our first bullish level up here. We got our bullish level down here. And as you can see, currently where price is now, we have potentially another level below. So we're just going to repeat the process. Clone. -2. I'm gonna do it faster for 5.9. You see, that's why Why you do? That's why you use a calculator. 0.01. That's why I use a calculator. Copy that. Paste there. There we go. Paste there. And then L negative 2. Perfect. Let's see if we got another level. Alright. L minus 3. Minus 0.001. As you can see, we're doing analysis mathematically. Tell me how many traders you see do that. Paste that there. That's L minus 3. And then if price action actually touched this, it doesn't matter if it touched it by a little bit. I project the next level because we're looking at ranges. If price action touched it, I'm projecting that it might continue in the direction, or and I'm giving it a margin of error to reverse as well. So I'm going to project the next level. So you always project the level that isn't touched yet. And I'll show you how to, manipulate that as well. Minus 0.001 again. Same process, guys. After you got it, it ain't that hard. And then I'm sure ChatGPT can also give you all the levels. My grid also gives me all the levels. What? I ain't tell me I ain't make a line. That's what I'm telling you guys. You gotta watch out for human error. That's why math is a lot better, because it'll let you know when you're wrong. Paste that there, and boom. And then since I don't analyze in exact pips, I do record the data in exact pips. I don't analyze in exact pips. I bring the level, I bring the lowest point of the box, the bottom of the box, to the furthest point there. And then I'm going, since price action did touch this line, I'm going to project another one above L plus 1 is going to give us L plus 2, which is going to express 20 pips above that level, which is going to be, I could do that in my head right now, 1.16. Just got a plus 2 to 1. I know I'm confusing y'all. Sorry. But you guys know how to do it. You're going to take 1.16135 plus 10 pips is going to be 1.16235 plus another 10 pips is going to be 1.16335. 1.16335. 1.16335. All right, and then we got it there. Remember, I keep saying range, range, range. This is the range currently. All right, just move it so everything is nice and spaced out, evenly able to see. Now let's zoom in. All right, let's zoom in. Let's zoom in. Let me reset this scale so it looks a lot cleaner for you guys. Let's zoom in, and boom. Now it's closer. For you guys, I really do like, that's why I feel like I'm going to do all of this for you guys. I'm gonna send it to you guys and everything like that, because I feel like not everybody has, what is like a 40, this is like a 30 something inch or 42 inch or something like that. No, and it's a curved monitor. Not everybody's gonna have a monitor big enough. You guys are gonna have like a regular computer screen or a laptop or just even your phone. So not everybody's like, is the way that I'm analyzing is only possible with a large screen. When it's on like a regular, which people have like 13-inch monitors, 15.9 inch, all those small things, it's a lot harder. But the math doesn't matter what laptop you have. The math is the same, and the math implications are the same. So now we have the range. Now we're going to identify each hour by just copying the last hour that we was at and then placing it on the first bullish and bearish levels, right? So I probably have to talk about the hour right quick for you guys. So the mathematical framework of the Bag Open Trading Grid based on Euro USD, I've identified that 10 pips is a great range, but since the duality of the markets, I'm going to project 10 pips above and below, because I don't know which direction market's going to go as a valid move forward or a valid move lower. So you have the levels. You just put the size of this box, or the size of the hourly range is 20 pips, and then you just line up the top of the box to the bottom of the box. That give you the projected range, right? Now, as you can see, interesting, right? Give me a second, guys. As you can see, I don't even like what I see. So I have to give you this caveat first, right? So what happens is on your trading broker, trading view, and the way that we get price is that at the close, at the open of the week, and at the open of each day, price usually gaps up where in reality, based off of spreads and all this volatility that happens in the market, it jumps, right? So the actual price of where market's at and the price that is expressed on the screen sometimes has a gap where it jumps, especially if you're going from your MT5 to trading view. It's going to be a big gap. And then at the end of 5 p.m. to the open of 5 p.m. is also going to have a smaller gap, but it's going to be a gap nonetheless. And then on MT5, based on your broker, I know that trading is closed and the market stop printing data at the first 5 minutes. So from 5 p.m. it's not gonna let you trade, and it's not gonna print data until 5:05. Don't worry about that right now. But I feel like there's other things that they understand, the algorithms and mathematical traders that already been there, and high frequency traders, especially, and scalpers and stuff like that, have found niches in the market where they trying to exploit those niches by manipulating spreads and the actual price that they give to you and the price that actually happened in the big guys, the liquidity providers, their charts, right? They skew the numbers to just put the odds against your favor. So let me double check I got the right weekly open. My weekly open has 1.16135. Yep, I got the right one. So yeah, what's pissing me off is that on the chart here, the open is going to be skip an hour. Look at that. Whatever. So boom. I'm not gonna explain that right now. So we got the weekly open price and level, and then we got the 20 pip range. And as you can see, at the 20 pip range, markets hit the top of the range, and I have to identify that exact 5-minute candle that it hit, or the red or green boxy thing that you're looking at that hit the top of the level, which is at 525. So theoretically speaking, if we had the perfect data, markets will start right here, and then it would move up here. When we get further on into data that's more accurate now, you'll see how it's connected. But boom, that's what we do. That's what happened. This is gonna be the first strike of the day, of the week, and I'm gonna put this green dot here. Now, this is going to represent from open to the high. We move a valid move of 10 pips. This is going to mean that I have to move this to the next level, because I have to, theoretically speaking, if I was analyzing in real time and we have more time left before the candle closes, I'm going to project that markets may move more 10 pips in this direction, and as well as allow it a margin of error to fluctuate before moving back down or whatever that it wants to do. Then I also change the color of this candle or this range for the hour to green. So when I'm visually looking at it, when I zoom out, I understand this is it had a net bullish value of plus 10 pips. 10 pips above the 8 AM candle open price means we move the value, move it 10 pips. We didn't actually get any higher than that, and it blah, 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 blah. Right? That is this candle, and then so on, etc. I clone the next one. Now, for a valid move of 10 pips, for a valid move of you're going to see I do that a lot because it is a tongue twister after a while. The last candle has a bullish value of 10 pips. The last strike was bullish. The value was bullish and positive. So the last projection was at L2. So I have to connect when I project the next box, the top of the box has to be connected to the last furthest level of the direction of the last strike and the value of the strike, right? So we moved 10 pips bullish. We hit bullish level 1. We didn't move anymore else within the range of an hour. So the current level is going to be up here. I'm going to start my hourly candle. The top of the box has to be here. And then theoretically speaking, if we didn't have the data that was already printed, we will start off with this range right here, which is a neutral range, which is back to that 20 pip range, our current level, 10 pips bullish, 10 pips bearish, and we're allowing price to fluctuate within this range to either continue moving bullish or reverse back. And what did it do? It reversed back. And instead of putting a red strike, because the last move was bearish, we have to put a blue strike, which means that we're now net zero or neutral, which means that we're back at where we started. But then, because we actually did move down, even though it's a neutral down move. Even though it's neutral, it was a bearish move against the bullish move. We're going to project lower. You never want the top or the bottom of the box to be at the exact level of the last strike that happened within it. Now, because this was a move down, but after it moved bullish, now we're at net zero. I'm going to color this as blue, just or call it a reset, a retracement, neutral move, whatever you want to call it, right? A neutral move and an idle move are two different things, and I'll explain that later. Now, like I said, the last move was down, but it's a reset because we had a bullish move. We project further because if markets decide to move further, we will get to this level lower over here, or it might go back up, whatever. The last level we have to connect to is now this lower level right here. I'm gonna do it in this example. I'm gonna do it based off, I'm gonna pretend like it's happening in real time as I explain it, but you could do it a lot faster by just skipping it. And later on in subsequent videos, you'll see me skip it. So theoretically speaking, we have to redo the range again. We are back at a 20 pip range for an hour. So that's how we measure price every hour, 20 pip range. And then markets move. We didn't touch the low. We didn't touch a high. Now we're idle. That means we didn't move a distance of 10 pips in either direction. I take a white strike and I do like that. Boom. Now let's go ahead, clone this again. Boom. Copy. Let's do this again. Line it up. So I like to line them up perfectly. I don't have like severe OCD, but I just like when things are even. So what happened is boom, boom, boom. At the last 5 minutes, we do touch the bottom of the candle or the bottom of the range, and now I have to project this lower like this. And I'm gonna put a red dot here. And then, since that was the last strike that happened, and the value is net negative or value is bearish, I'm going to do this. Change this to red. All right. Now, we move bullish 5 p.m. By 6 p.m., we return all that bullish move. We create a reset. And when we're right here, the probability of it continuing is more probable because price action likes to breathe before it continues sometimes, or sometimes it just goes straight. But the probability of it continuing the opposite direction and reversing in direction is more probable than it was when it just moved bullish. So the probability was there. We held the level for an hour, and then we actually moved lower, creating what is a reversal sequence, or is the price action has changed direction. Doesn't mean we confirm that. It doesn't mean that it's going to continue lower, but the probability of it continuing lower is higher than it was when we was here and when we was here. So So boom. Now, like I said, the last move was bearish. The value of the hour is negative. We're moving lower. We created our first reversal sequence. But as you can see, we did not touch the high or the low of the box, of the range. Blue, turn that yellow. We didn't touch. We held the level, and what we do, we're gonna put a white strike. Price action, held the level, moved idle. It didn't move bullish or bearish. It didn't have a bullish move, then went bearish to create neutral. It didn't have a bearish move, then moved bullish to create neutral. It didn't touch anything, so we keep that box yellow, and we just continue the same process using the same logic, right? It didn't touch. There we go. Clone. It didn't touch. There we go. It didn't touch. Remember what I said, like between 5 to 8 hours straight, it doesn't really move until London session. This is it. Now, sometimes it's all 8 of these hours are going to be this yellow idle move, but sometimes it'll move within a range of, let me see, where we at? You got the even. Move a range of this 20 pip range. You see, even though we're at the lower end of the range, it's still between this 20 pip range right here. This range right here. We're at the low end, but we didn't commit to moving lower and creating a continuation bearish sequence, which is 2 of the same color, which is 2 red dots or 2 green dots, is going to be called a continuation sequence. The probability of it continuing in that direction and actually trending in that direction over a longer period of time is higher when we have 2 of the same color. So if we would have went down one more level, we would have created a continuation sequence where the probability of it moving lower is now higher than it was before. Let's continue with that. And then you'll notice it's going to be more of these neutral candles than it is of a colored candle. All right. And guess what happened, kiddies? We actually didn't move lower, even though we had a reversal signal or a reversal potential or reversal confirmation. We didn't move lower because that can happen. We actually went back to the top of the box. Now, since we were moving idly for 1, 2, 3, 4, 5 hours, the last color was red. So the next color isn't green. It's going to be blue because the last move was bearish. We have to return that negative 10 pips first and then add another 10 pips to be considered bullish again. It's now we had an idle move. We returned that negative 10 pips. Now we're back neutral. And guess where we're back at? The beginning of the weekly candle open price, the daily candle open level, back at where we at, and what we used to identify that we're back at where we at. We're using a blue dot, and what's the mathematical implication of this blue dot is plus 10, minus 10, 0. Minus 10, plus 10, 0. Where we end at? Level L. I'm trying to give these guys an example, and you won't let me. Level L0. All right. All righty, kiddos. Now, what color is this gonna be? You see how it becomes damn near like a game, damn near like I'm playing Dora the Explorer with you guys. It's gonna be blue. It's gonna be blue because we didn't continue higher. Where was the last level? Because this was the last bearish move, and we're connecting all the candles to the low end, expecting it to move lower, or that's the last projection based on the direction of the last move. Boom, boom, boom. Well, I forgot what I was gonna say. It's a blue candle. Now, oh yeah, that's what we go. Now since we was expecting, wow, if we were speaking in terms of being present in the moment of the development of this candle, we're looking for price to either continue moving higher or come to the last level. It didn't, but because the last move was bullish, but it net zero move, but the direction is up. The last level projection is going to be up here and no longer down here. We're going to connect the next candle's range to that level projection. If we are pretending like the data didn't already the data isn't finished in this candle, we will start off with that same 20 pip range on the last level, connected to the high first. What happens is price action move lower, and it recreated this bearish move. Boom, and now we got a projected bearish again. Boom, we're gonna have to, we don't touch any more levels, so this candle now is back red again. Now where do we connect the next candle to? We're gonna connect it to the bottom of the range. The last projection. All right, we're gonna reset the value of the range, which is gonna be a 20 pip range with the center line with the 50%, where the middle of the 20 pip range is going to be on the last level. It's connected to the last projection, which is down here, and then you project obviously the other projection is 10 pips the other way. Assuming that we were in this candle, markets fluctuated, didn't do anything, right? So we're gonna go back and do like this. Boom. Next hour, let's see if we touch. No, we don't. We're holding the level. We're just fluctuating above and below the level without moving a distance of 10 pips. Even though from the high to the low, maybe 10 pips, it didn't move a distance of 10 pips. It fluctuated. Let's keep on repeating the same level until we get some action. Let me double check something right quick, make sure I'm not. Yeah, nah, I'm good. Trade's up $2. Probably was up like $5 a second ago, but there you go. Clone this over here. All right. So as you can see from this, let me double check. I think I laid it on there. Nah, not this one. We actually don't. Maybe it's the next one. This one's also an idle candle where we're still fluctuating. Let's clone another one. And there we go. So now you see we actually touched the bottom of the level. We're following the same process, but this time we created a continuation sequence. A bearish continuation sequence, right? That'll mean that the color of this candle is red. All right, the color of that candle is red. Boom, boom, boom. All right, the color of that candle is red, continuation. Even though we idled, right? The last move was bearish. The value that we're right now is negative 10 pips, which is 10 pips below the 8 a.m. candle the weekly candle open price and the daily level open, and then we move 10 pips. Now, theoretically speaking, if this information didn't exist, we create a continuation sequence where the probability of us moving lower is higher than not. lower is higher than not. And then you know what we do, we're going to copy this candle over, close it, connecting the bottom or looking at the last level projected from there. So that's what we have here. Clone that over, and I'm gonna do something for you guys. Then I'm gonna give you guys a curveball and information right quick. All right, let's recheck. We got a notification on our charts. So even though we did move 10 pips below the 8 candle open price, which is 5 pips below our entry on you guys' trade, we tried to get down to bearish level 2, but we pivoted back around in this range, this 10 pip range, remember? And it came back and touched that level again. We don't have to worry. For me, I need price to come back up here, which is that level right here, and then drop back down. Now, my trade isn't invalid until we reach over here, and we're not making any trading decisions on you guys' trade until we reach over here and into deeper profits. Let me open your chart here. You guys are back at $1.24. Where are we at with it? All right, so like I'm gonna continue the thought process. Then I'm gonna go back to show you guys something else. So what happened is we actually did touch this level, creating a bearish candle. And then what happened when we touch the levels? We gotta project the next level lower. And as we do with this one right here. Bro, did y'all not tell me I can't count? Hold on a second. This is level 1, 2. This is supposed to be level 3, guys. Why ain't telling me that? That's level 4. All right, I got it better now. All right, cool. Boom. Touch that level we projected, and now we're in our current range where I'll be able to show you guys how we analyze in real time now. On current price action, we're carrying the same bearish level lower. Move your ass over. This is our range. And currently, we haven't touched lower or higher, even though it looked like we are coming up higher to touch that line. Not until it happened is it real, and not until the close of the candle can we determine the color and the value, which is going to be whether it's going to be positive or negative in value, or neutral or idle, right? Now, right now, this is data that's already printed, already happened, but what I do when I'm explaining how I trade in terms of the grid for trading and not the grid for analysis is that right now I could, since all this is, copy and paste and you could put it on, take it off, all you want to, I'm going to back up a little bit because I'm going to dramatize. I'm going to give you guys an example of how when we start trading, let's see, 8 o'clock. Okay. Take all that off, take all that off, take all that off. All right. So what happens is if I would have opened the live at 7:45 or whatever, 7:45, this is the data that we would have had. This data wouldn't exist yet, right? And we would be over here waiting for the close of the candle or the 8 o'clock, right? To come for me to project the next hour, blah, 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 right? But because now I'm going to be trading at 8 o'clock, I'm going to recreate the similar grid with the same properties, but instead of being a grid for analysis and analyzing price action in terms of what actually is happening, I'm going to create a grid based off of trading that is going to be biased off of my trade, but it's going to analyze and track price action off of what is happening, but in reference to my trading session. When you're analyzing price action in terms of analysis, overall the week, the days, and the hour, you're trading what actually happened and it's based off of the weekly candle open price, the daily open level, the last level, the day close which will be the next level, which will be the level the next day opens at instead of the exact price. I'm gonna show you guys that later. But when I am trading and I'm analyzing what I am trading using the same framework, I create another overlapping grid on it. And I hope it don't confuse you guys, but remember, just practice makes perfect. The more you hear it, the more you see it, it's gonna make sense after a while. So assuming that price is, assuming the time is 7:45, no, assuming the time is at this time, let's assume that it's 7:55 and the close of the candle is gonna happen and we're gonna open at 8 a.m. I'm going to draw a 4-hour candle, an hour that is ranging a range of 4 hours, right? I will draw a 4-hour range instead of a hourly range because I trade from the times of 8 a.m. to 12 p.m. This is and if I want to hold the trade longer, probably be wider than that. But for the most part, when we're starting off, we're gonna start off with a 4-hour range we're gonna start off a 4-hour time frame, 4-hour session in a 20 pip range, right? Based off of the last level, the 7 a.m. hourly range candle closed at. Same concept, just instead of 1 hour, it's going to be 4 hours long. And instead of using the instead of now using the levels that's already on the grid, I'm going to use the levels that are on that is populated on MT5 by my key price level indicator. These lines over here is an indicator that generates these levels, and I'm going to base the new overlapping grid for my trading and in my analysis of my trading based off of the 8 a.m. candle open price, which is 1.15988, and I'm gonna show you how that works. So we're gonna take the 8 a.m. candle open price, 1.15988. I'm going to take my line tool from 7:55 to 11:55, which is actually 8 o'clock open to the 12 o'clock open based on a 5-minute chart. I'm going to draw a black line. Just change these values to black. I already forgot the open price. Hilarious. 1.15988. I'm going to change the values 1.15988, 1.15988, and then I'm going to name it 1.15988 so it's easier for me to copy and paste. So my trading range from 8 o'clock to 12 o'clock open at 1.15988. This is my new level 0 for my trading session, right? This is like, it's a customizable chart. It's a custom chart for what I'm trading, right? And then pretending price action, pretend like this don't exist right now. And I'm going to explain to you how it develops over time. So this is going to be the 8 a.m. candle open price. Next, what I want is going to be 5 pips above the 8 a.m. candle open price and 5 pips below the 8 a.m. candle open price is going to be the levels that I use to identify the bias that I'm going to trade in, whether it's going to be bullish above, bearish below. So I'm going to project, I'm going to clone this, and I'm going to add 5 pips to it. So 1.15988 plus 1.15988 plus 0.0005. Well, 10 pips is 0.001. 10 pips is, 5 pips is going to be 0.0005. Is going to give us the level of our bullish bias indicator. Paste that there. Paste that there. Paste that there. I'm going to change the look of the line. I'm going to use a navy blue color. And I'm going to not have a solid line. I'm going to have a dotted line because it's 50% halfway the distance of 10 pips, 5 pips, blah, 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 away above the 8 a.m. candle open price. And I'm going to do the same thing for below. Let's take 1.15988. We're going to subtract 0.0005. And that's going to give us below. Copy that. On the one I just cloned, I'm going to edit the values. Paste that there. Paste that there. And I'm going to paste it here. And then I'm going to change the color to a fuchsia or pink, whatever you want to call it. And I'm going to keep it as a dashed line. All right, boom. We got the 8 a.m. candle open price. We got 5 pips above. Let us know. And we have 5 pips below. That signifies if price goes up 5 pips or more, my bias for today is bullish. If price goes 5 pips below or more, my bias or my direction I'm going to be trading is going to be bearish. It's going to be bearish. What I want to go with that? What I'm going to go with that? And then what I want to do is I'm gonna create the range, right? I gotta pretend like none of this is there. So I got my bullish and bias identifiers. Now, because I trade within a 20 pip range, so I believe that at 8 a.m. price is gonna move either bullish and or bearish a distance of 20 pips. That's the range that I want to trade in. That's the range that I'm going to get into my trade and get out of my trade, or get into my trade and protect my stop loss. Or I can expect that's the minimum average move price is going to move within that 4-hour range and or more and or longer, right? So using the 8 a.m. candle open price and level, I'm going to clone it again. And I'm going to make my first bullish level. Same concept and same logic behind the grid, but just personalized for my trading session. Now I'm going to figure out 1.15988. We're going to add 0.001. And that's going to give me 1.16088. That's going to be my first bullish level of my trading session. Paste. Coordinates. Paste. Coordinates. Paste. Make this green. I like it to be a bright green because sometimes these levels overlap with the grid below it. That's bullish level 1, 10 pips above the 8 a.m. candle open price. Now we're going to do the same process. We can use the same price as well, plus 0.001. Again, that's going to be bullish level 2. I just added 10 pips to that price of bullish level 1's price. And then I just paste it there. Now, I don't do L plus 1, L plus 1, and L minus 1, all that stuff, because I'm doing it in the trading range. And then just to copy and paste, it's a lot easier to title the levels and the lines the exact price. So I could just edit it as I go. And it doesn't confuse me with the plus 1s and plus 2s that's already on the charts. Now, I got my first bullish move. Now, if I was in a buy position and markets wanted to move bullish, I draw out the first bullish levels, and then when price got to that level, that's going to be the completion of the average minimum range. Not to say price can't continue, but the trade idea has completed. It can continue, but the base trade idea has completed. And then I'm going to project that for below as well. Clone it. Take the 8 a.m. candle open price. Now we're subtracting 10 pips. 1.15988 minus 0.001. All right. Paste. 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 And change the color to red. There we go. And then we're going to do it one more time. Clone. 1.15788. You can do that. After a while, you can do it. But when you just start and use the calculator every single time. I'm going to fuck up plenty of times, but I know when I fuck up, though. All right. It might be overlapping a little bit hard to see, but basically we got the 8 a.m. candle open price. We have our bullish indicator for bias. We have our bearish indicator for bearish. We have our bullish level 1 and bullish level 2. That's if price action decides to move bullish, is gonna head this way. Price action decides to move bearish, it's gonna head that way. We got bearish level 1 and bearish level 2 in terms of our trading range. It's just imagine this is a piece of paper, and we just add another piece of paper on top of it, and then when we're done with it, we can just take that piece of paper, crumble it, and then continue working on the first piece of paper that's already there. Now, let's talk about price action that as it is developing. Cool. So We open at 1.15988. We move lower and we touch the bearish bias level indicator, which is 5 pips below the 80 candle open price. I like to use a black dot to identify bias. So whether it's up or down, I just use the black dot, right? Now we're moving. Now my bias for today is going to be bearish. It's going to be bearish. And then I am going to figure out what happened next. So what happened is we move lower and hit bearish level 1. Not only did we enter the trade at 1.15938, 1 pip below that. I mean 1 pip what did I do? 1 pip below that for spread purposes. I'll explain that in another video. But we not only did we enter in a sell position, you guys, my trade's up here. Not only did we enter a sell position, but price actually moved lower into profit a little bit. And then what happened? I think an hour passed by. So let me clone this over. Let me take an hour. You're gonna see how many times. Take an hour. So an hour. Put that on in the middle of the 80 candle open price. You got the bullish level 1, bullish level 2. We touch the bottom of the box. We have to project it lower. Another 10 pips here. We have a negative move lower, so we have to change the color of the range to red. All right, boom. Now we have a bearish candle. We touched 10 pips lower. We projected the next 10 pips, and then we have to clone this over using the same logic as the grid for analysis. Is the same logic as the grid for trading. But now we just have a bias because we're trying to make money, and it's based off of 8 candle open price. What happens is using the same 20 pip level. I know it's hard to see through all the lines and figure out what line you're looking at, but after a while you get it. Even if it's confusing now, it's going to be a lot easier. So what happened is in this range, in this hour and 20 pip range, we didn't go higher or lower from 9 a.m. to 10 a.m. So what happens, guys, we go ahead and put a white strike here as an idle move. And then we can clone another. What I do? Do I usually? No, I leave this yellow. Yeah, we can leave it yellow. I'm not going to confuse you guys any more than I'm confusing you guys now. Since it's an idle move, it's going to be exactly on the same levels. And we are at 10. Hold on, guys. 8:55. This range is not big enough. 8:55. There we go. Uh-oh. Your boy might have... What happened is this weekly open changed by 5 minutes. Instead of going from 4:55 to 5 p.m., it went from 4:55 to 5:05. You see how... And this is new. This never happened, so... You gotta love it, but math is math. No matter how much they try to manipulate things, it doesn't actually change anything. So I just gotta shift it over by 5 minutes, guys. Shift it over to make sure my other chart was right. My other chart was on the money. Let me just shift it over by 5 minutes. Give me a second. It's not gonna take long. Hey, there we go. 5 minutes. Watch this. I'm gonna fix it right now. Get your ass over. All right, so that would actually mean this is that. Even though I'm changing these around, the mathematical value remains the same. That's why you trade based off math. This switch this around perfect. This. There we go. And there we are. It's a live stream. I can't time lapse. Good thing the majority of these candles are idle. There was only one overlapping strike, so that's not bad. If you're on a video playback, go ahead and fast forward, I guess. 455. And like I said, I've never had this happen, but small things ain't never going. It ain't affecting nothing. It's just a visualization. MT5 is where you make your money based off of. That's why everything I do is based off of MT5. Just a visualization. Because a lot of these drawing tools you cannot use on MT5. There we go. 755 and 655. Perfect. Just move this dot over 1. It looks exactly the same. So that's good. 755. Let me fix this one right here. Now it's a lot more even. Cause I was like, bro, that it looking like we looking at the end of the hour, and it was like, what, 10:30 something. Okay, we were neutral. Air drummers. All right, was neutral. 10:55, and we're whoa. Wait a second. You see, yeah, we're neutral. This is the exact line we're supposed to be looking at. And then this is the next bullish level line right here. We're currently still in the development of the 10 a.m. candle to end at 11 o'clock. But since we are neutral, we don't have any strikes and nothing we need to do. We're just following price action as it moves, right? Mosquito. All right. So what we're looking at. Now we have our overlapping trading session grid. We have our bias for the day. Markets move 5 pips below the 8 candle open price. Our bias is bearish. And what actually happened? We did continue bearish. We created a continuation sequence on the overall market, probably like right here. But I don't know why I said that. let's start again. So we have our 8 a.m. candle open price. We move bearish to our indicator right here, 5 pips below the 8 a.m. candle open price. We move 5 more pips bearish, creating a 10 pip move below the 8 a.m. candle open price, reaching bearish level 1. And then we projected another 10 pips lower, projecting price to continue in that direction, bearish, or it can come back to the 8 a.m. candle open price, creating a reset strike. What happened is we actually didn't travel a distance of 10 pips within the range of the duration of an hour. And now we're at the development of the 10 a.m. candle that is going to close at 11, and we're still fluctuating within a range that didn't move a distance of 10 pips. The mathematical implication of that in terms of our trade. Using the 8 a.m. candle open price, we entered into a trade 5 pips below for a sell position. Let me get you your chart. We open into a sell position when price action reached a little bit below this level right here, the pink line. 5 pips below, and then we are currently in profit. I want to talk pips, so I would say we getting here around 5 to 6 pips of profit. We did probably reach 5, maybe 2.5, 8 pips, 8 to 7.5 pips lower, and we're currently idling. So now I could also start thinking or referring or explaining price action in terms of the week, and then in terms of the day, and in terms of what happened, right? So usually we will have news that happens around 8:30, right? So in the days that we have high impact news events, happens around 8:30, and based off of historical price action of me trading every day and me analyzing and measuring and documenting and trading, I've noticed that if we have news, price doesn't usually get to this level until around 8:25. I mean, when we do have news, price doesn't usually get to this level until like after 8:15 basically. But when we don't have news, it only takes 5 to 10 minutes for us to reach this level, and then it will continue on lower. Not lower, but it will continue printing price. What's happening is we did move a distance of 10 pips, but it's taken us almost damn near 3 hours to move a distance of 20 pips. Some days we can have that move, especially with news behind it, to high impact news behind it, to move 10, 20, 30 pips within 1 hour. Sometimes that 20 pips happen within 4 hours. Sometimes it happen outside of the 4 hour range. Sometimes it will fluctuate. So a negative 10 pip move, then coming back down to 8 a.m. candle open price, and then going 20 pips is also a range of 20 pips, but it's not a 20 pip profit in terms of your trade, because your trade is down here and you probably get your 15 pip profit around down here altogether. So 20 pip move. Yep. So we're just fluctuating. I would say what I'm trying to express right now is that usually we'll get a 20 pip move by now. We have 1 more hour. We have an hour and 15 minutes. I think within that hour and 15 minutes, we're either going to come back up to this level or we're going to move down to the next level, as well as statistical, I could say a projection that because we have these news events here, and you know what's skewing the information is too, okay, because we have these news events here and we have high impact news later in the week, in the beginning of the week, it's going to fluctuate, probably collect trades by going up and down within the same range. People are trying to day trade, catch those 100 fairy tale pips and stuff like that, and it'll just go to your stop loss, go back down to the bullish stop loss, go back down to the bearish stop losses, and then collect trades to move price for these high impact news events. Now, because yours truly, Donald Trump, or your government's truly, the United States of America, yours truly, the Democratic Republic of the United States of America, y'all shut down the government. It threw off all of the news events and the scheduling of news events. Now we have one of the most volatile news events happening within the week. Usually happens the first Friday of every week, which is NFP, and then you have different news events throughout the month. It usually happen around the same time every month. not the same number date, but the same number week and day of the week. But basically, it threw off all the news events. Now we have NFP on a damn near what, third week of the month. We on the third week of the month. Now they're giving us NFP. It definitely took a lot of liquidity out the market. So a lot of the movements that was supposed to happen for the last month or so, especially coming out of summer, didn't happen. Now I think they're gonna try to cram all of this price action, all these news events, in the end of November and in December, and then next year we probably reset with some fresh charts, right? But yeah, so basically what's happening is Wednesday, Thursday, and Friday are the news events. So I don't really expect price action to move a lot on Monday and Tuesday. It's going to probably give us a minimum of 20 pips within our range, a maximum of 20 pips within our range for the next 2 days. But that's based off a probability. It may move more or less. It doesn't matter. Because I seen a bank holiday. Y'all had Veterans Day a few days ago, and the Veterans Day was damn near the biggest day of the week, when usually hot bank holidays in America on EURUSD would probably move way less than every other day of the week, of the month, and damn near of the year. They only damn near move 20 pips or 30 pips on bank holidays where their banks are closed. But yesterday it moved 50 pips, and then on regular days, even days with damn near news on it, it moved more. So yeah, that's the range that we're looking in. We're gonna let it fluctuate. So that's that in terms of analysis. I told you about the grid. I told you about the trading session grid. I told you about the strikes and how they develop over time. I told you the mathematical implications to them. I said I had to make a video based off of the setup, but I think I'm gonna do the setup video on my own time, on a pre-recorded video. What else I have to do? I said that. The trading thing. Oh yeah, since I'm recording on my phone, I can't really show you guys the live trade. I already did show you guys the live trade that you're in. I'll probably chill off. Nah. Let's see. I did have to work on the that new range that I was talking about. Let's see. The static and dynamic hourly, daily, weekly equation. All right. I'll be working on some while price action develops. I'll explain it to you after I write it down, but bear with me, guys. All right, guys. So that is the 4. Blah 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 blah. Let me do this bullish, right? Turn this green. It's probably gonna be important for the end of the video. This has to be a bright green inside. All right, so that is the price action that happened within the 4-hour trading range. For me, the question I have for myself now is 4 hours went by. The price isn't in the price isn't invalidated. Do I leave my trade open? And for how long do I leave my trade open? And am I gonna go ahead and hold it on to the end of the day, 5 p.m. and try to close before 5 p.m.? Am I going to trail it over the day? I'm gonna leave the trade open. I'm gonna see what's gonna go on. I'd rather leave the trade open than close it, right? I'm a crybaby. Too much fear missing out. I'm gonna admit that it might be fear missing out that I don't invalidate the trade based off of time. And then price action. Then I have you know what? I'm gonna invalidate the trade. 4 hours went by. I didn't get into a trading position. Not only even though the price range didn't leave, fear missing out. It's gonna be another opportunity for another day, right? We'll call that quits. And then on the This one on. Wait a second. Oh, wait. What? Wait, what? I apologize, guys. Well, it doesn't really matter. I close. That's my bad. I close a live trade instead of closing the FTMO trade. No, I closed FTMO. Hold on, guys. Something is aloof. Oh, okay. I'm gonna show you what's going on. I had the expert advisor. I put it has to close all trades at the end of the 4 hour session. So it that's not nothing wrong with that. You see I put 1859, and it did it at 1859. It closed all my trades. That's what I set it as. I didn't. That's the settings. That's the settings, right? So all in all, I followed the trading system regardless. The Even though I what I needed to, I put a note there that not only do I need to invalidate the trade based off the distance move, I need to invalidate the trade based off time move, because the distance move condition wasn't met, but the time conditions was met, where we're out of the trading range. 20 pips within 4 hours did not occur. So we can live to trade another day, right? Even though I had to close in a small loss. Not gonna kill me. And then we could go ahead and analyze price action as it traveled. Price action in terms to our trading as it traveled over 4 hours, which is markets indicated that it was gonna be bearish for the day, moved 10 pips bearish, did not advance 20 pips within 4 hours, returned to the 8 a.m. candle open price. Why did I make this a green dot? This is actually, for you guys, it's actually a blue dot, because we went from bearish back up without moving another 10 pips. This is actually what actually happened. Neutral. We went back to the independent open price. We're at neutral level. Price action went back to 0, and then we are hovering over the 8 candle open price without going bullish or bearish. Price action can develop for the majority, can continue lower, can go higher, and it may stay in between a tight range. Here we did move 20 pips over the duration of the day, which I'm going to show you guys later. But that's the trading session analysis based off of my trading bias. And what I told you guys I do after I finish trading, I could go ahead and just erase all those things, and then erase all of this, and then go back to analyzing unbiased the price action that occurred on the grid in terms of analysis grid. So the next hour we hit bearish level -2. You went down 10 pips, creating a continuation sequence. So this is now going to be a red candle. Hey, red candle. Let's project this over. Boom. We hit a let's pretend like we're reading it in real time, or it's expressing in real time real quick for you guys. We project this over. This is a neutral candle right now. I mean, an idle candle right now, or just a blank space right now. We did this. We're watching price action move. We're watching price action move, and then boom, we went lower. We went traveled a distance of 10 pips again. What we do, boom, Hey, move that. Move that. There we go. Now we can make this candle red. Projecting lower. Clone this. And then what happened here, the next hour, which would start off like this first. And what do we see? Price action, and then boom, on the last 5-minute candle, we return back 10 pips. So we gotta project up here. This is going to be a neutral candle because we returned this 10 pip move back up here. Now we're back at that level right there. This is going to be a blue candle. There we go. And you know what I'm going to do? I'm going to clone one of these right here, so it's easier for you to see. Clone one of these. All right, so what do we do in this range? This is our level. We went bullish, we stayed around here, and we did not strike anything, so that's an idle level. We held this level, which is L-2, 20 pips below the 80 open price, and then boom there. So we are currently at the 12 p.m. candle, and we are currently at the 12 p.m. candle, and we are fluctuating, right? We're fluctuating still around this range right here, so we ain't got nothing to worry about. We're waiting for it to hit a higher low, or we can continue. So what happens is usually the move happens within that little 4-hour range I talked about, and then on average it just fluctuates around the level until we get head to the next day, continue fluctuating. So it might touch a higher low here depending on what it wants to do, and then when 5 p.m. comes, we're in a new day, and then we got 8 hours where it's probably not going to move that much, and then into the next trading day to see if we get some moves. Anything can happen, so we just looking at what's possible to happen and not what's possible. Let me take that off. I'm trying to move this. This don't look too aligned to me. There we go. There we go. Boom. All right. And then I'm just going to continue analyzing as is. So that is what we have so far. At the end of the day, maybe tomorrow, I'm going to have all the completed candles, and I'm going to show you guys how to populate the label here. That's going to let us know the amount of levels we have, quote unquote risk reward, how that looks and how it's calculated, and then the amount of pips we have total in terms of the range, the actual range, and the projection size. What else did I do? I'm going to tell you guys. I think that's about it. I'm going to turn off the live stream because I got to charge my phone now. And then I'm probably going to make some more videos for you guys and continue working on what I'm working on. All right. See you guys on whatever platform you see me on.